Good day, everyone. This is Nenad speaking, and today we will talk about how to measure breakout trades, the strength of breakout trades, and we will talk about advanced breakout trading. So today, Chris is with me. We are in a holiday trading mode, and definitely there is still chance to trade the markets as we did today. If you followed my analysis today, dollar CAD and gold, you could have made some pips because it's yes, it's the truth that we have uh, currently this holiday market. But again, I trade. Let's say that I and Chris also trade, not that active, but we can do like one or two setups per day. So it's still good to trade. Before we start, risk disclaimer explaining that online educational materials are available by Bear Markets Estonia for a global audience. And this is solely our opinion and in no way it represents the actual suggestion for a trade. This webinar is for informational and educational purposes only. A risk disclosure statement stating all possible risks associated with the forex market. By accepting the risk, you are also proceeding further with us. So we will start first with breakouts, and let's say that the breakout is something that regularly happens in forex market, but we have different types of breakouts. So breakout is what occurs when price exceed previously determined support or resistance levels. Long positions are triggered when price move above resistance, while short positions are signaled when price drop below a clearly defined level of support. It means that on lower time frames you can scalp trading breakouts, but on higher time frames it can create a significant change because it can lead to a so-called trend change. Uh, Not all patterns that happen with breakouts are equal in strength, and usually we need to measure a potential breakout. For me, guys, because on my Camarilla MACD trading, I have different rules for trading breakouts. Most of the time, I try to trade breakouts. I try to trade it. I call it a type 3 trade breakout when it goes with a trend. But also when there is a counter trend move, as we have, let's say on Euro AUD and Euro Dollar today, we had a counter trend move, and it's clearly that after the divergence, breakouts are even stronger. So you need to distinguish between breakouts on lower time frames and higher time frames. Okay, now what is important to say, huge momentum spikes can also lead to very fast profits. And breakout trades usually are the fastest way of making profits. We still need to distinguish whether a breakout is a true or false. But you know, guys, if you trade a breakout and you don't succeed in a breakout trade, probably that is resembles a false breakout. But still, we need to use some rules in order to distinguish whether the breakout is false or true. I personally don't like to risk a lot when trading breakouts. My rule of thumb is if I'm in a breakout trade, 100% of the time I will protect my profits, because a lot of times happen that I'm like 15 pips in profit, price gets to 15, 16 pips and then drops. Well, that means that the breakout was false. Still, some stops were collected and price made some pips, but because of that, we never know until we lose a trade whether a breakout is false or true. So I tend always to protect my profits, and that is how I trade. Maybe some other traders have their different methods, but guys, honestly, if you trade on lower time frames, such as let's say 1 hour, 30 minutes, 15 minutes, even 5 minutes, you really need to protect your trades. If you go with 4 hour trading, then you will probably experience a drawdown, but you will probably also hold on for a trade for, let's say, for a week, or some traders even hold it for longer. But intra-week trading is usually 5 days maximum holding on to a position. So I would definitely advise you, whenever you make a breakout trade, well, try to protect your profits. If you don't protect your profits, then, well, that breakout can be actually very strong, and you can make like 50, 60 pips very soon, instantly, maybe on some pairs. But well, on other pairs, it will go for 10, 15 pips, then probably it will reverse and drop. And that is why I prefer really to take those trades. For example, yesterday there was a GBP Australian dollar trade that I spotted. We made a trade and we actually protected our profits for 20 pips. The price went 35 pips, and then after some GBP news, it dropped. Because of those GBP news, guys, if you trade GBP, and because of intraday fundamental news, there is a big possibility that a good breakout might turn into a false breakout, especially in today's market conditions. You never know what can happen during a press conference or when two important persons meet. Let's say yesterday we had some important GBP meeting between, I think it was UK Prime Minister Mr. Theresa May. She held she had some conversation related to Brexit, and just after the conversation, after the meeting, GBP dropped. You know, before the meeting, GBP was bullish. After the meeting, GBP was bearish. So we managed to protect 20 pips. If we didn't protect it, well, you could have made, like, let's say 30, 35 pips, and then if you actually had held a trade, then you would probably have lost your trade. That is why it's very important to protect your profits during intraday trading. And breakouts always do stop grabbing. So because of that, very often you will see that the price actually gets into a nice momentum trade, and then either it will continue or it will reverse. And that usually happens during the first resistance. So what it means is basically you're taking let me grab the pointer. You're taking a breakout trade from this level, and this is next resistance. Breakout might happen here, and then it's time to decide: is it going down, or is it going up, or is it going down? If it's a false breakout, it will go down. If it's a true breakout, it will proceed even more to the upside. Because we don't know whether the breakout is false or true, we need to protect our profits. And I always try to protect my profits close to my Camarilla pivots, or if I see that level cannot break that easily, I tend to move my stop loss in profit. And it saved me a lot of times. Maybe, well, sometimes I cannot take like 60, 70 pips, but I'm happy with 20 pips because, guys, you need to know breakout trades are mostly scalping trades, happen during the day. And as I said, you never know whether the breakout is true or false until it happens. When to trade breakouts? Well, usually it's around London Open. You can also trade during Frankfurt. We traders call that session Frankie Fake. And you have, let's say that you can also do your trend trades, positional trading. And if you do breakout and put another position in your already in a trade that is already developing, then it's called scaling in. So breakouts can be added to your existing positions. If there is no trend, then we say that the price is range bound, and usually those kind of breakouts will lead to losses. But you know, guys, if price is trending, let's say this is a major, this is a major range, and this is minor range. So if the price gets above this minor range, usually it hits the major range, then reverses in between these ranges, and it can stall a bit. That is the time when we lose trades, and that transition period from ranging market to trending market can also be time when you're in position that you can lose a trade. But that is why I'm saying losses are normal. You don't need really to aim for huge percentage of winning trades. As long as you keep your money management, you should be safe. But as I say, when I spot a good breakout trade, I enter a breakout trade, but I'm always protecting it, always. That is my rule of thumb. When there is a nice breakout pattern forming, let's say double bottom, triangles, wedges, and pennants, you really need to be ready to trade. You have three ways to trade breakouts. I will cover it too. So, opportunities and dangers for trading breakouts. Breakouts are a fast way of making profits. Price has a huge momentum spike as it collects stops above below support resistance levels. It's called stop grabbing. So let's say that the price is dropping below important support after, let's say, it formed an M pattern. Let's say this is M pattern and price is dropping below the support, 0.2. What it will do usually is the price is collecting all those weaker stops that have been put for long positions. And because of that, you see a fast surge in price. You see a momentum surge. That is why when I see a breakout, I do a trigger happy trade. But I can also add if a trade retraces, I can add in trade hoping that the price will make a BPC pattern. It's called breakout pullback continuation. So it's very important, guys, to know. I will show you an example of that type 3 trade. Unfortunately, I missed this trade today, but it was very, very good on my Camarilla MACD method. But as I say, sometimes I miss these huge moves. Well, even though I use alerter, I'm not, 100% of the time in front of my PC trading station. So I tend to lose some good trades. And I lost one day. It's euro dollar. It's euro Australian dollar. I will show you. But definitely that was an example of a good breakout trade. So you need to know one good breakout trade is enough for a day. If you get 10 to 25 pips, it's good. And you can always try to buy into resistance or sell into support, especially if the trade shows a divergence. And if you do it, you need to be ready to protect your profits, because have in mind that breakout trades are stronger if important resistance or important support are broken. That means that the price will do its stop grab and will continue in that direction. Without it, guys, well, if you don't know how to trade, if you don't know how to protect your trades, most of the time you will lose your trades. I need to be honest with you. So that is why protecting your trade while it's in profit is very, very important. Do not trade trigger happy trades on higher time frames. On higher time frames, guys, breakout pullback continuation pattern or a breakout retest pattern is good to trade. These trigger happy trades are not so good for higher time frames. You need really to understand the implications and to know that. False breakouts are common. If you experience it, we need to immediately close the trade and then reverse it. Trigger happy trades make more profit, while retest trades are usually safer. So we distinguish between these four types. I don't do breakout, pullback, retest, continuation trade. I only do trigger happy trade, BPC, or a breakout retest. Also, we have DAHL breakout, type 3 breakout, and false breakout. Also, these are types of breakout trades. Trigger happy trade is taking the trade immediately after the price breaks lower support, usually by few pips. Usually you will notice that there are some triangles, some wedges patterns, maybe some channel lines that might signal a trigger happy trade. So once a breakout actually happens, you need to distinguish whether it's what kind of pattern it is. If it's a triangle pattern, the strength of breakout is determined by adding the height from support to resistance into a breakout onto a breakout level. So if this is a breakout level, you need to measure the distance between the descending trend line and horizontal trend line that makes up for this triangle, and then add the distance to the downside. Chris will also talk more about it, but have in mind that all these trades can have its drawbacks, especially if it's a false breakout. Then the price might get to half of the move and then start moving in the opposite direction. It can happen, but you need to be ready for that too. Breakout retest is also taking the trade after the price retests broken support. So price made its move like a trigger happy trade, but then it made a retest. Once the price makes a retest and continues for a few candlesticks below the tested candle, then you can say this is a breakout retest trade. So price needs to come and retest a breakout point. Then it needs to make up retest candlestick, and if the price breaks this retest candlestick to the downside, then we usually think that retest is successful and that the price will continue moving down. We also have breakout pullback continuation on higher time frames. This is a good pattern. Chris likes to use it on his SWOT 4-hour trading method. And when it happens, you have like point 1, point 2, point 3. Point 1 is when trigger happy trade makes. Point 2 is the end of breakout. Point 3 is a retest or a pullback. And continuation trade happens few pips after the point 2. So price makes 1.1, point 2, point 3, retests, and then proceeds into a breakout direction. The break of point 2 by few pips is a signal for a BPC pattern or breakout pullback continuation. The strength of the move is also determined by adding the distance between a horizontal and another trend line. In this case is descending trend line. You can also trade ascending patterns, like for example you have like ascending pattern and price makes the move to the upside. You need to add the difference between the ascending trend line and horizontal trend line and add to a breakout point. The stronger the move is, guys, the more pips you will make instantly, because usually after a continuation trade there are some fresh sellers or fresh buyers depending on a breakout trade showing, and then they actually give price that additional momentum. And now, guys, let me show you actually what I mean when I say this. So this is I unfortunately missed this one, but this was really a great trade today. It was a Euro Australian dollar breakout trade, guys. This is my type 3 breakout, and it uses some custom made indicators. So this was point 1 here and this was point 2 here, and you see the price was going up. It was a bullish trend here, very bullish trend, but then we see that ATR has been touched and the price, this was a scholastic example of a breakout trade. Really, this trade was so good, but unfortunately I missed it. So, well, guys, it happens. You see point 1, point 2, the price has hit the ATR, and I wasn't there to trade this and watch this breakout. It was so good. The price made 60 pips of breakout, and all these levels have been hit. Now the distance between, if we take a look here, guys, and we make a trend line here and here, the distance between, I will do it like this, okay? Okay, not like this. Yeah, I actually need to unray this trend line. Okay, this is okay. So we copy this here, okay, and we add here. You see where the price stalled exactly at this point, and it made even a higher move. Now there is a retest, but at this, now watch this trade, guys. This was a breakout trigger happy trade. This was a sort of retest, not a full retest because price didn't quite retest at this level here. But then it made a continuation trade here. So this was breakout, pullback, continuation trade. And if you add the strength of a breakout, okay, as I already showed you, okay, we can also do it like this. Fully projected breakout. And you see, definitely this was the place where the price should stop here, very close to this daily L4 line. So yeah, I mean, it was a very good trade, but unfortunately I missed it. Dollar CAD was good. Ilya is saying the dollar CAD was that it will bounce tomorrow, maybe, but we did today. This was the analysis, and I actually joined for a small trade with a very low risk, and now it's unfortunate that I use very small trade. But then again, guys, this was a good one, and I said it will go down, and definitely it was respected. So Now, in this example, if you made your trade here, you need to place your stop above this point here. So it's very, very important that you actually place your stop loss here. Now, if you actually make, it doesn't matter, for all these trades, stops should be placed definitely above the breakout spot. Okay, so here our stop loss would have been placed above 0.2. Now, in the case of chart, let's use standard template without any, let's say, naked template. Here, if you just take a look at one single pattern that usually signifies a breakout, like flags, pennants, it doesn't matter, guys. We will use standard breakout here. You need to use the pole. This is the pole. This is, some people call it flag. Some people like to call it just a pennant. It doesn't matter, guys. This is basically the flag, and a breakout is measured by adding this flagpole to a breakout point. And watch this. The full breakout was projected here. The price actually made it to previous support that was signaled by the candles here. It didn't make quite it down, but you see, it was a very strong breakout. Here you had another example, guys, of a breakout trade here. And if you add this to the breakout spot, actually, you see, even higher. It went even higher. But that is how I usually manage the strength of a breakout. Still, guys, as I say, I really like to protect my trades once in profit because, well, especially if you're trading during holidays, we have a lot of ups and downs because of profit taking, and the price might get into two-way positional trading. So it means that it can go up, it can go down, but usually I not usually, but 100% of the time I protect my trade always. It's just sometimes that if I don't, let's say that I traded this pattern here and I put my stop loss here. So once the trade continues, I tend to move my stop loss. And if I'm stopped out, I'm usually stopped out in profit. So that is how I do it. And that is how you can also measure the strength of a breakout. Yes, it's risky market, especially not just because of elections. It's holiday trading mode, guys. So if you trade, of course, you need to trade with lower risk. Now, another trade that I wanted to show you, another potential, not trade, but another potential strategy that you can go with breakout, but also, guys, in form of scalping. It's so-called breakout of high and low. So for that, you can use our indicator. It's free for you guys. ECS box indicator. So it actually gives you possibilities to trade breakouts of highs and low. I call it DHL breakouts. So you just need to compare previous day and take a trade today. So if we traded today, we needed to watch this previous day. Breakout of previous day's high can be traded. You see, breakout of previous day's low can be traded. Today, guys, this is the previous day low and the previous day high. It's marked by these boxes. So I assume if this breaks to the upside, then it will make some move also towards the ATR or pivot point. But you need to know, guys, that it doesn't matter which time frame you trade because these levels are same on every time frame. You need to be very careful, fast on your fingers, and you need to protect your trades once in profit because then you never know whether it's a false breakout or not. And one more thing, how I measure false breakouts. This is one thing that I do. Let's just say, for example, that this is a London session. Okay, this is a London session. I need to actually use my Camarilla indicator for this. So we will just use this example on 1 hour time frame, 15 minutes, it doesn't matter. So let's say, guys, that this is a London session. Price hits daily L3, it's bearish. But it didn't proceed, it actually switched the color from black to white. So as soon as it switches the color from black to white, you go with a long trade. Okay, long trade. And this is usually a false breakout. Price hits the level, switches from bearish to bullish, and then it proceeds up. So that color switch, if it happens during Frankie Fake or London session, that signifies for a false breakout. Let's say this was a down move, okay, and you see, let's use this example just for an example. This was a London, let's say the London trade happened here. Price went up and it went down, and then as soon as it hit this level, it switched its color from black to white. It means that it's a false breakout, because you see daily L3 was broken and it went up, but you need to be on time in order to spot it. So try to use this, guys. I hope that you enjoyed, and definitely, guys, Chris has also more to say about this. I wish you a safe journey, safe trade, and talk to you soon, guys. Okay, if you have any questions, do not hesitate to ask me.
Thank you so much, Nenad. Great stuff there. Really enjoyed the presentation here with breakouts and fake-outs. I wanted to add just a couple of notes. Nenad went through a lot of great examples. I just want to add some of the examples as well, but maybe on higher time frames, we take a look a little bit at some swing setups, for instance. The theory has been well covered by Nenad, so great job there. Let me change the screen. There we go. All right. All systems go. Let's continue. And well, basically breakouts and fakeouts, for me, the most valuable piece of info ever that could be available are candlesticks. All right, Japanese candlesticks, and how price responds to those levels. Now, not everyone uses candles. I know that there are traders who use line charts, bar charts, range charts, Fibonacci charts, and I think that all of them have their value and their advantages. But I think specifically for breakouts, the candlesticks do have an edge because of the fact that you get very useful info about the balance between bulls and bears. So that's my main guideline for looking at whether price is breaking or bouncing. The second step is, the zone itself. How strong is it? And is price approaching that zone for the first, second, or third time? So it's a little bit of an equation. And it basically means that if we have strong support or resistance levels with a lot of confluence, then a bounce is more likely. And if it's a weaker level with not much confluence, a breakout is more likely. And the second factor where we consider whether price is approaching it for the first, second, or third time, then I think personally that the more price approaches a support or resistance, the more likely price is actually going to break it. So the first time, price typically respects it on average more often. But if it's approaching it the third or fourth time, a breakout chance, even if the support or resistance zone is strong with a lot of confluence, that chance increases if price is approaching it time in and again. Why? Well, basically because if there is a resistance level and we draw it like this, and price hits it first time, moves down, hits it again, moves down, it's the third time it moves down, then it's basically making a sideways pattern. And the sideways pattern often is an indication that price is consolidating for a continuation breakout. And then typically, eventually, you'll get the break and continuation. So these are my three main kind of elements I use for measuring break and bounces. So we can take a look at some of these examples on the 1 hour chart on the euro dollar. Everyone likes the euro dollar, I guess. Not everyone, but a lot of traders like trading the euro dollar. And so let's start with that. Let's just renew this template a little bit. And I want to focus a little bit on some swing trade setup. So let's see. We can go a little bit back in time, maybe to yeah, maybe here's a good spot. All right. So this is where we had a lot of bullish momentum back in November, and price was making a consolidation correction like this. All right. And basically, price was respecting the support and respecting resistance. All right. But the overall kind of momentum was up, and this was a sideways correction. So a breakout to the upside was expected. So if you're looking for a break or bounce, right, you would be in this case looking for a bounce at support and a breakout above resistance, right? Just looking at the analysis, which is always something we have to do first. Then we kind of decide which part of the chart we want to trade. And in this case, we were doing this live, and a bullish bounce or a bullish breakout all made sense. Now, I traded it a little bit in between. It's not the best example, but I traded it, I think, somewhere in here. As price was breaking a local resistance for breakout, there was a break, pullback, and continuation before we got the bigger breakout. All right. So now in this case, I want to focus first on candlestick patterns. All right. And let's take a look at that. Maybe on a 4-hour chart, we would see something more clear. On the hourly chart, we don't see anything substantial here. We see two bullish candles. When I look at candlestick patterns, obviously I'm looking for the well-known candlestick patterns that most of us know, like bearish engulfing twins, pin bars, etc. We have had webinars in the past that are specifically focused and explain these candlestick patterns in detail. So I'm not going to do that here again. If we don't have a specific candlestick pattern, then I just look at the candlestick itself. One of the major things that I think is valid, regardless if we have a specific candlestick pattern, is that each candle gives us info. Each candle shows info by the size of the candle, the volatility basically of the candle. So a bigger sized candle is more important than a smaller candle. The close into high or low, and the relationship of this candle versus the other candle, the one before it often. That gives us plenty of info to understand the psychology within that kind of smaller unit of time. So, but if we don't have much particular information to retrieve, like in this case, these candles there, I mean, more aggressive traders might consider already this to be a bounce at support, but it is a bit of a question mark. So if it's not that clear, my rule of thumb is typically to wait for a second bullish or a second candle in a row, either bullish in this case or bearish, obviously for bounces at resistance. So that typically, when you get two bullish candles or bearish candles in a row, is also often a confirmation of a turnaround if you are looking at a bounce in a good zone. So this was already information that was interesting for a bounce on the hourly chart. Regarding the breakout, this candle right here or the one after that are breakout potential candles. And why? Because this is a good size. It is a candle close near the high, and if you look at this candle and compare it to the previous candle, obviously the close is above the previous close, the close is above the previous high, the high is above the previous high and close. So it's obviously a higher low, higher high continuation of this candle, of these two candles. So that is a good sign. The candle close itself is the only thing that would make me a little bit doubt, because of the fact that the trend line is only broken by a bit. Let me close the mini terminal for a second. All right, and the trend line is broken, but not by a ton. So that's the only one factor that would make me a little bit hesitant. Plus, the Admiral Keltner channel is not really broken. It is challenged, but not broken. So the next candle would remove all of those doubts, and therefore I say that both are possible as breakout candles. The next one is not a very good close at a high, but on an hourly chart, a small wick like that, considering the third candle, I think is still fine. And you get a continuation. This is a momentum breakout on a higher time frame, and price ultimately goes for a pip pool of about 70 pips to the upside, and then still makes a continuation after the consolidation for another 100. So it depends on how you manage that trade, if you get part of that 70 or part of that 170, and how much patience you have. Obviously, with swing trading, the upside here takes 28 hours. The continuation takes 49 hours. So we're talking about a trade that takes a day or two. As you can see, that is obviously not so strange for a swing trade, for an interweek trade, and that could happen on these time frames. So that's not so, that's so strange. You got to be ready for that on a time frame like an hourly chart. That could happen. Now, we can take a look at that same zone and see how the 4-hour candles look like. Sometimes it's good to switch, because these are my time frames I use the most, and it's good to switch between both, because sometimes you get a different view, and sometimes the trade will be apparent and clear on a 4-hour but not an hour, or the other way around. So sometimes it's good to check both charts for different candlestick patterns. And basically, this was, I think, a pretty good bullish candle reaction to that support zone. And this was a pretty good breakout on the 4-hour chart. I think the breakout candle on the 4-hour chart is pretty straightforward, pretty good. I like the volatility. I like the close near the high. I like the fact that price has broken above the resistance trend line so much. Now you might wonder, hey, how about Keltner? Isn't that close? And that's true, but when price is showing such a good candle, as I said, got to think about how much confluence there is in that zone. In this case, I would not consider Keltner to be a serious challenge to the breakout, because of the fact that price is making a breakout candle with the trend after a correction, and there is not much confluence in this zone. There's no fibs that I think are very important. The top is further away. As I said, support and resistance is mainly an obstacle if there's confluence, and the zone is more important. This particular area I don't consider to be that hefty, and therefore the chance of a breakout is higher than a bounce. So that's something always to keep that equation in mind. Confluence versus how many times has price broken or attempted to break. And this was the 4th attempt. Depending on your count, actually, it could be more. This is maybe attempt 1. This is attempt 2. This is attempt 3. And yeah, you could even say the 4th. Or this is just one continuous, breakout, and just consider it as one attempt, and that would be the 3rd. So because it's already attempted so many times, a breakout, and considering the fact that there's not much confluence of resistance at that spot, I think, and considering also the candle itself, good 4-hour breakout in my view, and good 4-hour bounce. Let's take a look at maybe some false breakouts. All right, so false breakout, obviously a breakout that fails, does not deliver the follow through that we expect, perhaps. So let's see if we can find a little bit of an example. Maybe we can consider, maybe, well, we can talk about this one for a second. Maybe we had a breakout here, good candle, and we get follow through, but ultimately the follow through fails, and you can see a big wick here, and we get a bigger correction. So it is a little bit of a false break of the channel, at least, right? So that could be one example of a false break. Let's check and see if there's something more going on that we can discuss as a false break. Let's see. I don't see one at the moment. Let me go a little bit back into the past then. Here too, good breakout candle here, as you can see. Still continuation. Also here, good breakout. Good breakout. I think false breakouts, do not occur maybe that often on higher time frames as they do on lower time frames. It is a factor to realize and be aware of. Specifically, if you get good, 4-hour candles to follow up on that, then they don't occur that much. I'm really struggling even to find an example, to be honest, of a false breakout. That's funny. Ah, here. All right. So, gotcha. Finally, right? So we have downside momentum, strong candles to the downside, as you can see. Correction, downside, correction. So yeah, logically, naturally, if we get a follow through support, there could be that breakout to the downside, and wouldn't be strange at all. We can put a fib from here to here, and we would expect price to go to these targets. Now, we did get a break, but it quickly went up, as you can see. And if we were at least keeping an eye on the 4-hour chart, we would know that the downside does not have much hope, that this breakout is looking very much like a false breakout due to the massive wick at the bottom and the doji close. So that breakout, definitely finding a lot of support and not a good breakout. So, and indeed, we got a bigger correction and still price moves lower, but it made a pretty sizable correction first to the upside. So we can take a look at this particular example in lower time frames. I'm not sure if I missed it now. Sorry about that. Let me zoom back up again. Here it is. All right, so let's take away this red line. All right, so we have a breakout candle. This is what Nenad was showing too. Remember that breakout and all of a sudden, boom, upside, right? So when you see that, when you see a V-Valley reversal like this, that is not a good breakout often. So what you want to see on lower time frames, and this is the second part I wanted to actually discuss, is the fact that when you have a breakout, it is always good to take a look on lower time frames to see if there's a pattern. So what I like to do is a pattern after the pattern. You have a pattern price breaks through that pattern, and is there a pattern on a lower time frame after that break? So we have a pretty big pattern here. For instance, let's say this is an hourly pattern. Price breaks through that hourly pattern. So we can zoom into this 50-minute chart. And on a 50-minute chart, what we want to see is price break, build a pattern, a smaller pattern. It will not be the same size as this one. It should be way smaller. And break again. Why? Because that pattern, a smaller pattern after the break, is indicating consolidation, is indicating that a false break is not likely to happen, that the bulls are not mounting any rally, and it indicates that if there's a new bearish breakout, that the breakout is solid. So that's why the pattern after the pattern after the pattern on a lower time frame is a little trick I use to avoid false breakouts as the breakout is occurring. The other trick would be tip would be to look at those higher time frames and see how the candle closes. So as you can see here, clearly, price did not manage to hold, and it fell and made a very strong, sharp rise and rally, and that's a V-Valley reversal, not a bear flag, obviously. So that would be a bad example of a breakout, right? A false breakout. This is. So let's take a look at the 50-minute chart, and we'll take a look at the dollar yen very soon. Very quickly, let's take a look at an example of a good breakout. Then let's take a different example. Let's take a look at this then, right here. All right, so we're on a, this was probably a 1 hour correction, right? This is a 1 hour correction. Let's take a look at the, no, wait, here, 1 hour correction. So let's take a look at the 50-minute chart. All right, there we go. All right. Not really a great pattern, but we do have a little bit of a hook back here and continuation. So that's a bit small. On a 5-minute chart, maybe it looks a little bit better, so you can keep an eye on 5 and 15-minute charts. And what you're looking for, this is not the best example, but what you're looking for is some type of consolidation here that reads a pattern. I don't think it's a great pattern, to be honest, but when it does reject at the resistance, the broken support at the 50 fib, and then starts to move lower, I think it's still a pretty good signal that more downside is likely. But I was actually wanted to show you a little bit better pattern. So let's take a look at maybe a dollar yen and see if there's something to discuss. Actually, here there was a breakout of this resistance with this candle. That was a pretty good breakout candle, in fact. One that I ignored and didn't trade, but it was a decent 4-hour candlestick there. All right. So this was a triangle. Sorry, wrong time frame. This was a triangle. Maybe on the outer chart, it's actually a bit better. On the outer chart, triangle, right? So what is the pattern after the pattern? The pattern after the pattern is here. This is the pattern after the pattern. And once we get a break of that, it's indicating that a false breakout is unlikely for the moment, and a push higher is still favored. And the target is the next fib, the 78.6 fib. And there's a small space from that breakout from 113 to 113.40-ish. But you see the difference? Break, consolidation compared to the euro dollar, break and fall like this. Or in the case of the euro dollar, it was a rise, right? Break and rise like this. So imagine the break and fall like this, rather than price going like this. Major difference, and helps a lot with sorting out good breakouts from false breakouts. So that's an example on the dollar yen. Flavius is pointing to the euro dollar on 19 December 20. Let's see. Yes. Breakout candle indeed. And it was fighting at the resistance at the R1 that we discussed in webinars with Admiral Markets earlier this week. Good 1 hour breakout candle, and price going sideways after that. Going sideways and then making the breakout dash up to 119. Good example. On the 4-hour chart, it was not as clear, so that's why sometimes you gotta indeed keep an eye on both of them, because on the hourly chart was a good candle, 4-hour chart was so-so. So it can sometimes depend. All right. Let's see. Any questions maybe that you have for breakouts or false breakouts? False breakouts are, also interesting reversal signals, especially if there is a false breakout against the trend. Those are even a little bit better because then you're trading a false breakout that actually turns out to be a false breakout with the trend. Those are neat. Now, not everyone is a breakout trader or a fan of trading breakouts. I like it because I like the confirmation of that particular move. So I tend to use that concept a lot. In fact, now it's not to say that I don't trade earlier with the euro dollar, for instance. I did trade it in here, right? And then we didn't get a full breakout yet because overall my analysis said that the likelihood after this correction to the upside was just so advantageous that I didn't want to wait for that breakout. So it's not always that I wait, but generally speaking, I like breakouts as a confirmation. It's just that if I always do my analysis first, and if I really like the structure and patterns, sometimes I trade it before that. I trade the bounce, or I trade it before the breakout. Here in New Zealand. It could be okay, and it is trying to break through this trend line, and we have a pretty good bearish candle. So that's excellent candle, and pushing through this fractal, that's all good. On our chart, is a little bit mixed because of the fact that momentum was pretty strong to the upside. I'm a little bit mixed on it. I think it could be okay. It's just that I would probably not trade it because of the fact that the holidays are next week. And this is not a trade that will probably be over by the end of tomorrow, I am guessing. So from this point of view, I would probably be a little bit reluctant to trade it. I think that it is a bit counter trend because of the strong upside we've seen on the Euro New Zealand. It's a interesting idea. I think it's has its merit, but maybe with the holidays, I think I would skip it and be a bit more cautious. We got to also realize that the bounce up ultimately still could be very much at support, and a bigger rally to test resistance, maybe to get a head and shoulders pattern here could occur, right? We got a left shoulder head, potential right shoulder here. So a rally to get up there and then fall down again could happen. So not a bad candle. It's decent, but considering the analysis overall, I think that it is a little bit risky that price might make a bounce in this zone here, and there's not much space to that. So with that in mind, the space in mind, I mean, it could break below that, but what I consider the space here is a tad small, and I would probably rather wait for more info on the Euro New Zealand. That's my view. With the holidays in mind and the fact that the market will be closed a little bit longer than usual than a normal weekend. All right, but great example and good to discuss. So Great job. Let's see. Ozzy might be making our breakout that I think maybe from the audio he looks a little bit better to me. In my view, maybe a little bit better. I think the space is a little bit wider towards the -272 target. Yes, Kiwi dollar is also trying to break, indeed. Definitely. It hasn't broken yet, but could. And yeah, these are pairs that might make a breakout tomorrow, I would say. Or, I mean, later today, before the weekend. So that's about it for today. Thanks for joining us on this December evening. And we're looking forward to be back next week. We have, I think, some webinars, maybe not the full schedule, but I think there's a webinar or two. So join us next week before we move on to a new trading year, 2018. Yes, the time has already arrived. And in the meantime, wish you good trading, folks, and talk to you soon. Cheers.